So, David, I'm going to start with you because you've got this fancy hat on, give you a chance to explain what it is. 2023 was the year of the non-recession, right? The recession that wasn't. So as we get into 2024, has it been canceled or just rescheduled?
I don't know that I would say rescheduled or canceled. The business cycle's never canceled. We will eventually have a recession. I think for 2024, the important question to ask is what did we learn from 2023? And how can we be better at understanding the economy and financial markets in 2024 with that in mind? And I think what I took away from 2023 and what I tried to push with our clients was that when you look at monetary policy and you look at how restrictive it is, you can't singularly look through the lens of interest rates any longer. You have to bring the balance sheet and the interest rate structure together. And we spent a lot of time developing at the beginning of last year these ideas that there was an enormous amount of liquidity in the system. These balance sheets are massive. Fed's balance sheet was $9 trillion at its peak, 40% of GDP. You go back to pre-global financial crisis, it was 5% of GDP. So that liquidity was still in our system, and the assets that were on the balance sheet were sort of shock absorbers for losses in financial markets because they had bought so many long duration assets, which again was also a stimulative, a very stimulative part of the equation. So for me, the takeaway from 2023 that you want to bring into 2024 is that while rate policy went up 525 bips, balance sheet policy stayed very accommodative and is still quite accommodative. And so we didn't really beat the economy up that hard. And I guess that's a lot of the reason why we just had 6 quarters in a row of north of 2% GDP growth, accelerating in the last 2 quarters. And a lot of the disinflation that came with that was really due much more to supply side forces than demand side forces. So to me, the takeaway is we're not in that restrictive of a place. The Fed's largely done its job at fighting back the inflation spike that came through the supply side. We can get back to even accommodative policy at some point this year. And more importantly than when do they go and how much do they go and everything else is that they can act again, that they don't have to fight that inflation. And the kind of Federal Reserve backstop put structure is kind of in place, something that has been missing for a couple years now. And I think having that backstop means that you can dial your risk up. Whatever you were doing last year, you're supposed to be dialing that risk up even further this year because the Fed can, if needed, cut 200 or 300 basis points fast, bring in balance sheet funding facilities, do a lot of the things that it couldn't do in 2022 or 2023 because they had to really make sure that that inflation shock was being managed properly. And so we sit back I think in a pretty good place as we head into 2024.
And your hat, for those of you who can't see it, it's a J with a crown.
Well, I always have a hat every year for our clients. Last year was our junk bond hat. The year before was a broken-hearted hat with QT on it. We've done a lot. We had hearts with QE on it because I do love QE. It is one of my favorite things when we can do it. It's a great elixir, great drug. I think Jay nailed it. And I spent a lot of the last 2 years defending his actions and saying this guy was not going to go down in the history books as Arthur Burns. He was going to fight the good fight and make sure that inflation expectations stayed anchored. And he did that. And whether it was through a little bit of luck or a little bit of smart, he got out of it without much scathing. And I think there were a lot of pundits that have sat on stages like this that really went hard on Jay over the last 2 years. And it's, I've been writing a lot of pieces and making a lot of statements that I think we should be applauding his actions. He gave us tough love. We needed it to get the inflation down. And here we sit, and the inflation's down. And remember, the last 2 years weren't that great. The S&P's unchanged for 2 years.
Yeah.
With 4,800 to 4,800.
Yeah.
A little dip and a little rise. So it has not been a great run in the last 2 years for equities, especially when you think of how fast the economy's grown in nominal terms. and even how fast it's grown in real terms in the last 6 quarters. So, he had to deliver that pain. He did what a central bank is supposed to do. He anchored inflation expectations, and the dividend from that is that he can act to backstop us again, like he had been doing before with COVID, or as Bernanke was doing post the global financial crisis. So,
Mike, do you agree? Did he nail it?
So far, I think I think the Fed gets a bad rap as well because they were really fighting the government in this inflation fight. It's amazing, in 2023 even. I mean, the federal government spent 6-7% more than they did the year before. I mean, the federal deficit increased by 6 to 7%, which is incredible. And that sort of like one hand fighting the other hand. So I think he was dealing with that dynamic. The Fed was dealing with that dynamic, and I think as David rightly points out, I mean, there were a lot of policy things going on that people weren't really recognizing. Everybody was focused on interest rates. There was this liquidity elixir that was going on, and there was this big fiscal elixir that was going on, which explains a lot of what happened in the stock market last year. The growth that we got was very low quality growth, right? It was government spending, which is very inefficient, as everybody knows. And it led to a situation where inflation actually was still eating into costs. We have, the government's overpaying for stuff. And that inflation is a cost for a lot of businesses that they couldn't pass on. So if you look at the performance of the stock market, everybody knows it's, whatever last year was his 8 stocks until the fourth quarter when Jay pivoted and the Treasury kind of squeezed us on issuance. And so that, until that moment, though, it was a very narrow market, smaller businesses, cyclical businesses that have, leverage. They're not flat over 2 years. They're down 20% or 40%. And we were chatting, and we were chatting, backstage. I mean, a lot of these VC investments are just not being funded at all. They're just going to go to zero, and that's good. I mean, and that's the tough love that Jay delivered, and that was necessary because we just had too much excess coming off the COVID boost that we just overdid it on. So I think he did a good job. But now there's still aftershocks that are going on that have nothing to do with the Fed, but have to do with the pandemic itself and then the response to that pandemic, which is both a fiscal and a monetary response.
Well, and it seems like there's this want to focus on the market movement over everything else, right? The pushback on some of that might be nothing's really changed with the economic fundamentals. The only thing that's changed is that the stock market has gone up since October. Suddenly we declare a soft landing. But we know the quote, right? The market has predicted 9 of the last 5 recessions. I think we can update it now to 14 of the last 8 recessions. So if the market is so bad at predicting recession, what makes us think it's so good at predicting a soft landing? I'll start with you.
Well, I mean, I think the market is no different. I mean, it's basically all of us collectively making a bet. And I mean, obviously forecasting is a tough game. Just ask Yogi Berra. And I mean, it's hard and it's uncertain, and the data sometimes is not accurate in what you're looking at in the moment. And so like things just, they bounce around. So I agree with you. I don't think anybody should be, betting the ranch on the outcome in the economy on what the stock market is saying. I mean, I make a living at trying to determine what the market's telling me about, what's working and how that affects, but it's not the only thing that we look at. And I don't think it'll be any different this time. I also would say that because of the pandemic, one of the things that's happened is that we're getting way more volatility in all of the economic statistics, right? So since the crisis, the post-financial GFC crisis, everything's been compressed, right? There was extreme policy, so you had no inflation, you had no interest rate volatility, you had no labor costs, everything was very predictable for companies, and that game is over. So you're just gonna have a lot more volatility in the economic variables, which creates opportunity because some companies can take advantage of that, and it creates risk for companies who get eaten up by that. One of our best themes in the last 2 years has been just buying companies that are the better operators, right? The better, in every industry there is a superior operator, right? Walmart versus Target is a perfect example. They're just better operators. And so when these things happen in the economy, they can deal with it. And I think that's here to stay. Like, you should be paying a premium for good operators. And that's a theme that probably will persist whether we have a recession or don't have a recession.
I just add to that, I think that's absolutely right, but I would also, and I don't venture down as far to the micro as you do often, Mike, but I think one thing that's really been different in the post-COVID era and with this interest rate spike is that for the first time in a long time, capital structures matter for companies. You can have a great company But if you've got a bad CFO that didn't set up the right capital structure, you're screwed in this higher rate environment. And the Fed told you, you've got to take some pain, and you did. So I think a lot of the CEOs that I speak to at Jefferies who want to understand the macro, and by the way, it's unbelievable how many banking clients I speak to just as a macro guy compared to where we were before because of what's happened here. It happened after the GFC, and then it went away, and then it's back big after COVID. I just think capital structure matters a lot more. Interest rate volatility is probably here to stay. Real rate structures as high as these that have persisted and are likely, I think, to persist for a while in a world of flush liquidity with big balance sheets, I think just it's a different operating structure for a lot of businesses. And I don't think that's good or bad. I just think it creates a lot of potential winners and losers and makes probably the long short equity guys happy that there's other things to distinguish, not just being a good operator of your business. It's not enough to run a great business and have a great product. You've got to have a great capital structure now. And you really didn't have to think about capital structure with the Fed doing what it was doing with rates so low and volatility so low and inflation. Now you got to think about it, and that's a big difference.
Okay, so having said that, we're supposed to talk about risk appetite, right? So when we think about risk, first of all, you can tell us how you would define risk for your clients. Most clients define it as losing money. That's just what risk means. I think about it in more of a risk budget perspective, right? Every portfolio has a risk budget they can spend. As soon as you've spent your budget, you're tapped out. So if that were the way to frame it in 2024, where do you spend your risk budget?
Well, look, I mean, I think last year was a year, and we can debate whether how tight they were on monetary, but tighter monetary policy. Okay, so you had a year of tighter monetary policy and very loose fiscal. And this year you have a situation where you probably got tighter fiscal and looser monetary. All right, and sort of my view on that is that means rates are probably lower. Real rates probably come down. The Fed will cut as if real rates go up, they'll cut faster as inflation comes down, and that means, and that's unequivocally good for duration. It's good for bonds generally, okay? And we saw that trade from October, right? The best risk-reward trade from October to January, everybody's talking about the S&P 500 or their favorite stock. I mean, long duration bonds are up 15%, risk-free. That's pretty damn good. So that value has kind of been priced a bit. And then in the stock world, I think, once again, it's going to be idiosyncratic. I don't think it's going to be as narrow as last year, because last year was really those 10 companies cutting costs. There was one, NVIDIA, that had real organic growth that took off, but the rest of them was just a cost-cutting story. And I think, but it's going to be companies like that. So next year it should broaden out to high-quality growth cyclicals or growth companies, high-quality growth that can actually generate pricing power in this environment, whether it's a capital structure issue or an operational issue. And that's where you should spend your money. You should spend it on individual sort of stocks, not on the big index. The big index is full. It's priced, okay, for all intents and purposes. The value is not there. The value is underneath the market now. If you're in the soft landing camp, you want to be buying individual stocks that have the ability to grow in price. And then on the rates, I'll let David talk about kind of where within that structure he thinks the best value is, but it should be a pretty good year for bonds. Now, credit's already pretty tight, so it's really more of a rate call and just that you're earning again. You're earning a good real yield, 2%, nothing wrong with that.
Last year our call was high yield. It was junk, which was our tiptoe back into risk after getting out of all of our risk trades in 2022. Thankfully, certainly our risk parity trades. I go back to what I said in the beginning. I think you're meant to dial up the risk from where you were last year, and certainly from where we were in 2022. And the reason is not because the Fed will cut every month, every meeting starting in March or every other month starting in May. We don't know what they will do. Will is the worst word when we're describing the Fed reaction function. The Fed can. The Fed can cut 100, 200, 300 basis points if things get messy. The Fed can create a balance sheet funding facility like the BTFP to deal with regional banks. If there's a problem in commercial real estate, they'll create a funding facility. And if they get to the zero lower bound, they'll restart QE. The Fed put structure, which has never been more powerful, with funding facilities, QE, and rates, and never gone through more technological advancement than it's gone through in the last 15 years with all of this unconventional policy, has never been more of a backstop than now. And there were 2 years that we just had to live through where Jay Powell told you, he said, look, guys, I'm not here for you. That's what he said in 2022. I'm not here. I can't backstop you. I got to fight this inflation. I got to take rates up fast, and it's going to hurt, and get out of the way. And I'm going to do that because in the long run, inflation expectations are anchored. This thing's coming back down, and I will once again be able to backstop you. And here we sit. 2 years later, we took the pain. The fire trucks went and put the inflation fire out. And Jay and the Fed infrastructure, which has backstopped this market through many, many varieties of supply and demand shock, is back in play. So you were missing a line item for the last 2 years. It's called Fed put. It was in the Excel spreadsheet that you had with all your other line items, whatever you had NVIDIA, and you had Microsoft, and you had whatever other stock and individual fund structure and long bonds or whatever it was. And then there was this thing called Fed put. And it was great. It's fantastic.
Would it function,
and he took it away.
Would it function the same, though? So they've got two options this year. They can cut because they want to cut. They need to normalize, right? And we talk about it as normalization of policy. Or they cut because they put the put back in place, and which would be in reaction to something going wrong, data weakening, something's gotten worse.
Yeah.
Right now, the market is priced, the S&P is priced at 20 times forward earnings, right? You can only assume that in the situation where things get worse and they have to put that put in place, that 20 times earnings is way too high.
Well, that's why, look, I made a career at Jefferies out of the last 15 years. This is my 15th year of advocating risk parity style trades. What has worked at Bridgewater and AQR and others, they're all weather type structures where you have a leveraged fixed income hedge for your equity long. And you couldn't do that in the last 2 years. I think you can do that again. And if things get messy, those fixed income hedges are going to pay handsomely. So that's really where I'm coming from in terms of the risk appetite story. Dial it up, have your hedges, and also know that the Fed does have your back in a way that they haven't for the last 2 years, but the way that they did prior. Doesn't mean we can't get 10% corrections, 15% corrections, or 20% corrections. We had a 25% drawdown in 2022. We went from 4,800 to 3,600 like that. And did the Fed put come in? No. Jay basically stood there and said, you guys are on your own. In fact, in August of 2022 at the Jackson Hole conference, I think he used the word pain over 20 times in that speech, and the market was right there at 3,600. He did not care that we went down 25. Any other time, post the GFC, we had a 25% correction. They were either doing QE2 or QE3 or, cutting rates back or pushing expectations back. So I'm just saying, you're back to that structure where they won the battle and they can bring the put back. And that means you can dial up your risk. So to find the right risk appetite this year, take whatever you did last year and turn it up a little and put a fixed income hedge on it in the back months over futures. So that's the trade.
So for those of you in the room who were lucky enough to buy the Mag 7 last year, congratulations. If that's what people did last year, Mike, do they turn the risk up again on the Mag 7, or do we start sprinkling into other things?
Yeah, well, it's narrowing already, right? It's down to, I think it's the Mag 4 now, and it's related to earnings, right? I mean, earnings for some of these are falling by the wayside, and so it's getting harder even for some of those businesses because they can only do so much on the cost side, and then they got price. So I think the market is going to broaden out but it's not going to broaden out to like junky small caps or cyclically geared businesses that have bad balance sheets that now have to get refinanced at these higher normalized rates. I just want to go back to what we were in the risk budget thing. I think the most important development, and David's already said this one way, I'll say it a different way because I'm not as smart on the fixed income side. The way I think about it is that rates, the most positive thing that happened in the last 2 years is that rates have fully normalized on both a real and a nominal basis without the system blowing up. I mean, if you had told me they were going to raise 550 basis points in 2 years, I've been like, good luck. I mean, this thing's going to be like a powder keg. And there were certain areas of the market that were powder kegs, but they deserve to be powder kegs, okay? Stocks trading with, negative free cash flow for 10 years. I mean, come on, that stuff's a joke. So that stuff did blow up. and we took that pain, but we can move forward with higher normalized rates, and actually, I would say really positive real rates, which is a weapon in portfolio construction. That's what it's good for. Like if you have higher rates, not only can J. Powell use that to help you, but you can use it in your portfolio now. When rates are negative 300 basis points on a real basis, like what good is that? That doesn't do anything for you if there's a calamity. It's not gonna offset your equity losses.
100%.
So I think that's right. You dial up the risk, but you dial it up on both sides, right? Fixed income now is back to its old sort of value, which is it's not only yield, but it's actually a diversifier against calamities, and that's a different place.
And it might be, you might want to have it in real yield, or you might want to have it in nominal yield. We could have that debate, but I think that's a really important point. And I guess I want to go back to the balance sheet. And I've studied the Fed balance sheet all my life. I had the privilege of working at the Fed in 2009 when we were first debating the size of QE1 when I went back as an advisor after I left Brevin Howard. We do not spend enough time thinking about how important these big balance sheets have become in their impact to the economy and their impact to financial markets. And one of the reasons I think, and I would have been with you, Mike, one of the reasons I think we all kind of thought a 525 basis point move in rates would have just punched the economy in the face is because we lived through things like 1994, where 300 basis points punched the economy in the face, and Mexico went bankrupt, and Orange County went bankrupt, and the world was, Goldman Sachs lost 25% of its capital in a year. It was a mess. But we have this $9 trillion of high-powered money sitting in our veins, and we didn't do anything with it. We left that massively accommodative balance sheet in the system as we raised rates, and it nullified the power. And then the losses that got absorbed in those balance sheets created stimulus as rates went up, because you had winners that had locked in low rates, and the losers were in the central bank, they weren't in the private sector. All of that, to me, suggests that central banks are gonna look at this, and they're gonna come away thinking, you know what? This world of higher real rates, of a higher rate structure, and a bigger balance sheet actually works better. And I think that's why Lori Logan's out there talking right now about stopping QT. We're going to stop QT probably somewhere around $7 to $7.5 trillion on the Fed's balance sheet, which is where the size of it is now. It's a little, probably 7.6 trillion. That's a colossal balance sheet. And we're just going to leave that there forever. That means $7 trillion of our debt will be permanently funded by monetary printing. So out of the $34 trillion of debt that everybody's so nervous about that we're never going to pay back, $7 trillion is always going to be with the Fed forever. Done. Kids don't have to pay that back. That's the end result of where we stop with QT. And we are using that stimulus, and that is a huge stimulus, that accommodative side of the balance sheet, which I think is what lifts earnings and lifts nominal GDP and lifts profits and lifts valuations. We're going to leave that there, and we're going to offset that by running higher interest rate structures. So we're not going back to the 2019 yield curve, which was flat at 2%, and a balance sheet that was 18% of GDP. We're going to go to a Fed balance sheet that probably stays at 25 to 30% of GDP and an interest rate structure at 3%. And I think a lot about what that means for value versus growth, what that means for companies' balance sheets, what that means for volatility. It brings volatility and rates up. And it probably means that multiples, as you were asking about, like cash flows out in the future aren't worth as much, but you have a huge cushion in that balance sheet, a nominal cushion to things like earnings and profits.
So does the cushion then, Mike, does it lessen the blow of the pain that we've talked about? Jay Powell said we need to inflict some pain, everybody be ready for this pain. The pain hasn't really happened yet, right? How much pain, given the cushion, how much pain can the market take, can investors take before it starts to wobble? So things like unemployment's back down at 3.7%. Can we get it to 4.5% without people freaking out? Can we get GDP down to 1.4%, which is where the Fed predicts that it's going to be this year, without people freaking out? What's the threshold?
Yeah, I mean, it's interesting. I mean, I think David lays out a very interesting framework that's very worthwhile and worth thinking about. And with that context, the Fed itself is projecting kind of this unexciting outlook. Now, we all know their ability to predict is as good as mine. So, but they're basically
All of us.
with this.
The collective,
Don't just
the collective
everybody.
mind.
With this knowledge, with this knowledge that they have, they're still saying it's going to be a bit of a slog. Okay, so I think the pain. When people say the word pain, it's like, oh my God, things are blowing up left, right. No, but like it's like almost like an erosion. Okay, so there's an erosion of companies that probably shouldn't exist. I mean, like in the QE era, like true QE and negative real interest rates. I mean, there's a lot of businesses out there that shouldn't exist. And so they're just going to slowly become less important. It's going to become a more concentrated sort of probably public equity market, but that will create new opportunities too. You know, with new technologies and things, there'll be new things that pop up. But like there's a big part of the world, the economic world, that is on its way to zero. Okay, and I don't know how long that takes. The question is it fast enough where that creates a labor cycle, right? Because don't forget, half the people in this country are employed by those small, medium businesses, or unprofitable businesses in some cases. So does it get bad enough in the near term that there's more of a mass firing and then unemployment goes to 6-7%? I have no idea, but I would say the risk is non-zero. I mean, that's for sure. It's probably a 20-25% chance. We just don't know. It's not 70% chance like people thought a year ago. And that's just where we are. You know, and I think that's how we got to think about it.
So I'm going to close this out with the question that we talked about backstage, that you said when you meet with clients, this is the second or third question that you get, so I'm sure there's people in this room who have the same one. How does the election affect the risk appetite that people should have, or maybe it shouldn't affect it at all? How are you framing that? I'll start with you, Mike.
So, I mean, it's been surprising to me that this question is already coming up. Typically, and I've been doing this long enough, every 4 years, that we get the question. It usually starts in after the primaries are completely over, maybe like May, June, because that's when you can kind of determine at the sector level like what's going to be important. Here are some truths that we kind of know. Usually, in election, presidential election year, the market doesn't really do much the first half. Now, this year may be different because of the pivot that we just saw, but and then you get all the action when it becomes clear who's going to actually win. It's almost like a sigh of relief, and you get usually a pretty big fourth quarter. The other thing that's always the case is everybody worries about healthcare. Just guaranteed. At some point in the year, it's going to be, oh, healthcare's screwed. That'll happen at some point. There'll be a 20% drawdown. It's a buying opportunity, okay? And then there's going to be the idiosyncratic things. I think the three big topics that are going to come up are tariffs, obviously, because if Trump wins, the presumption is he's going to tariff everybody to hell. Number two is going to be immigration. How are these two parties going to deal with it differently or collectively? And that issue may actually come forward. Like we may have to deal with that before the election because it's become such a hot issue for the Democrats. I think it's a real negative for them. They're going to have to do something. And then probably the third one is going to be around taxes. Obviously, if Trump were to win, I think there's a presumption that we at least extend the taxes, further out that we've already had for corporate, or there could be new taxes. And those are the three big ones I think that could move markets in a meaningful way. But it's just early. It's very early to be having these debates in any kind of serious manner.
I'd say the biggest one that I look at is regulation. I think deregulation was a big driver of what happened in 17, 18, and 19 under Trump. I think the market will come back, look at that, and generally speaking, how you dial your risk appetite up, the higher probability we go for Trump, if it's a Trump-Biden race, which it looks like it is, I think the more people are going to focus on that and focus on what that means specifically in markets, and that's a positive. It's a net positive on a Trump win. It'll be up more, and people are going to buy on that. There isn't going to be this, if everybody remembers what happened in 16, the market went down 10% for about 12 hours, and then you had to chase it for the next 2 years. I think Jamie Dimon probably said it as well as anyone could say it. A lot of these policies are what we in financial markets would really like to see. Maybe you wouldn't deliver them the same way as Trump delivers them, but the policies are the ones that people are going to buy risk on. And so you dial up your risk appetite the more you think the likelihood shifts to Trump.
Okay, we finished on a high note, politics. Thanks, everybody. That's our time.